Your credit score, it feels like a secret, doesn't it? This hidden test that controls so much. Getting a car loan,
Yeah,
buying a house, even just renting an apartment sometimes.
absolutely.
And it's weird, right? You pay off debt, think you're doing good, and bam, your score dips.
Tables all the time.
Or you need new credit, apply, and you get penalized too. It's just so confusing.
It really can feel unfair.
So, are you tired of guessing how this all works? This one number seems to hold way too much power. You want like real control over it, want to actually save thousands on loans. Then stick with us for this deep dive. We're going to pull back the curtain a bit. Here's a killer insight to start. That perfect score. Sometimes chasing that can actually be a trap.
A trap. Okay, tell me more.
Yeah, like a trap. Sometimes the habits that seem good can backfire.
Wow, that sounds counterintuitive.
Totally counterintuitive, right? So join us for this. We're revealing some unique truths.
I'm in. And, I love digging into the sources you use for these deep dives. They're always so insightful.
Thank you.
Seriously, it's not just the same old advice you hear everywhere. It feels like practical, tested wisdom. It fills in those gaps that other content just seems to miss.
We try.
And if you're listening and thinking, is this really for me? I kind of know about credit scores. Absolutely it is. Even if you check yours all the time, I guarantee you'll hear something that makes you go, I didn't know that.
Yeah, I bet.
What you'll get here are real, actionable steps. You can stop the guesswork, feel, empowered when you're making those big financial moves. And seriously, understanding this stuff can save you tens of thousands, mortgages, car loans, even just getting that apartment you want.
That's spot on. So we're diving into that mysterious 3-digit number, right? Usually somewhere between 300 and 850.
The magic range.
People call it your financial report card. It basically tells lenders, hey, how risky is this person? High score, you look good. Low score, well, borrowing gets tougher or way more expensive.
A lot more expensive.
But who actually comes up with this grade? Like, who are the graders here?
Okay, so it's mainly 3 enormous private for-profit companies. You probably heard the names. Equifax, Experian, and TransUnion.
The big 3 credit bureaus.
Exactly. Those are the credit bureaus. And they collect just staggering amounts of data about your financial life. Every loan, every credit card payment, if you paid late, any defaults, it all gets funneled into their databases. That collection of data, that's your credit report.
Okay, so the report is the history, the raw data.
Right. It's like the detailed textbook of your financial past. Now, here's the distinction that trips people up. Your credit score. That's the grade they calculate from that textbook.
Oh.
And the companies that actually create the scoring models, like FICO, which is the most famous one, or VantageScore, they use their own secret proprietary formulas to generate that score.
Secret formula, so like we don't get the exact recipe.
Nope, it's their intellectual property.
That definitely creates a bit of a power imbalance, doesn't it? A single number cooked up in secret, and it dictates these huge life decisions.
It really does.
You mentioned it could cost people a fortune. Like, how much are we really talking? Give us an example.
Okay, think about a mortgage. Let's say a $300,000 loan. The difference in interest paid over 30 years between someone with an excellent score and someone with just a, fair or okay score could easily be tens of thousands of dollars.
Tens of thousands. Just because of that number. Wow.
Yeah, it's huge. And it's not just mortgages. Car loans, definitely.
Yeah.
Landlords use scores all the time to screen tenants.
Right, for renting.
Insurance companies might use a version of it to set your premiums. Even some employers look at credit reports during background checks. It really weaves its way into almost every corner of your financial life, like a master key or a locked door.
It absolutely is. This isn't just some, theoretical number. It's real money, thousands of dollars out of your pocket. Feels like a game, and if you don't know the rules...
You're at a disadvantage.
Exactly. Okay, let's unpack this, because there's so much common advice out there about credit that turns out to be just, wrong. It's like trying to find your way with a really old map.
You're so right. There are loads of myths floating around, things people accept as fact that actually hold them back or cost them money. It's definitely time we busted some of the big ones.
All right, let's do it. Where do we start? What's the biggest, most common myth you run into?
Okay, the big one, the one that causes so much confusion, I think, is the idea that you have just one single credit score.
Yeah. People say, my score is 750, like it's this fixed number.
Exactly, like it's etched in stone somewhere.
Yeah.
But that's just not how it works.
So it's not true. How many do we actually have then?
In reality,
Yes.
you have dozens, potentially many, many dozens of different scores.
Dozens. Seriously. How is that possible? If I check my score on, like, my banking app, what am I even looking at?
Okay, so think about it this way. First, you've got the 3 different bureaus, right?
Yeah.
Equifax, Experian, TransUnion. They don't always have the exact same data on you at the exact same time. Maybe one has an old address still, or an account gets reported slightly differently. So the source data can vary a little.
Okay, step 1, different data.
Step 2, you have different companies creating the scoring models. FICO is the biggest player lenders use, but there's also VantageScore, which is often what you see on free sites. They use different math, different algorithms.
Different recipes for the score.
Exactly. And then layer 3 complexity. FICO itself has dozens of different versions tailored for specific industries. A car dealer probably pulls a FICO auto score, which weighs your past car loan performance more heavily.
Okay.
A credit card company might use a FICO bank card score. And mortgage lenders, they use very specific FICO mortgage scores, often looking at scores from all 3 bureaus.
Whoa. Okay, so the free score I see on my app, it's useful, but it's probably not the exact score a mortgage lender is going to pull when I apply for a home loan.
Almost certainly not the exact score.
Yeah.
That free score, often a VantageScore 3.0 or 4.0 or maybe a FICO 8, it's still really valuable. It's a great educational tool. It helps you track your overall credit health, see if you're trending up or down, understand the impact of your actions. It gives you a good general picture. Just don't assume it's the specific number the lender will use for that big decision. Knowing that helps you manage expectations.
That totally reframes things. It's not about hitting one magic number. It's about understanding this whole range, this family of scores. Okay, powerful myth busted. What's next on the chopping block?
All right, myth number 2, and this one causes a lot of unnecessary fear. Checking your own credit score will hurt it.
Oh yeah, I hear this all the time. People are genuinely afraid to look because they think the act of looking will drop their score.
Exactly. It creates this weird anxiety and stops people from actually monitoring their own financial situation. But here's the truth. Checking your own score or pulling your own credit report from sites like annualcreditreport.com, that's considered a soft inquiry.
Soft inquiry. And those have zero impact.
Absolutely zero. None whatsoever. So using those free credit score apps, checking through your bank, pulling your official reports, totally safe. In fact, you should be checking regularly. It helps you spot errors, identify potential fraud, and just understand what's going on with your credit profile.
That's such a relief to hear. So what does cause a score to dip then? Those are the hard inquiries.
Precisely. Hard inquiries happen when a lender pulls your credit because you've actually applied for new credit. Think applying for a mortgage, a car loan, a new credit card. Those specific actions can cause a small, usually temporary dip in your score, maybe a few points, but checking on yourself, always safe.
Okay, good to know. Huge relief for probably a lot of listeners. All right, here's another one I hear constantly, and it sounds sort of logical on the surface. Myth number 3. You have to carry a balance on your credit card from month to month to build a good score.
Oof, this one. This myth is not only completely false, it's incredibly expensive advice.
Because you end up paying interest, right?
Exactly. Think about who benefits from you carrying a balance and paying interest. It's the credit card companies. They make money that way. So they're probably not in a huge rush to correct this misconception.
Makes sense.
The truth is, you absolutely do not need to carry a balance or pay a single cent in interest to build good credit. What the scoring models really care about is your payment history. Did you pay the bill on time? That's the critical question.
Not whether you carry debt.
Not at all. In fact, paying your statement balance in full every single month is the ideal scenario. It shows you can manage credit responsibly, pay on time, and it saves you money. It's the best thing for your score and your wallet.
So just pay the statement balance by the due date. That's the goal. Where did this crazy, expensive myth even come from then?
It's hard to pinpoint the exact origin, but it definitely serves the interests of lenders by keeping people in a cycle of paying interest. It's a perfect example of how common knowledge about credit can be flat out wrong and actually harmful.
That's a really important one to get right. Okay, let's stick with credit cards for a second. What about tidying up? Myth number 4. Closing an old credit card account, maybe one you hardly use, is generally a smart move. Feels responsible, right? Like decluttering.
It totally feels like the responsible thing to do, getting rid of that old plastic you never use. But, this move can seriously backfire when it comes to your credit score.
Really?
Right.
Why? How does closing an old card hurt you?
There are 2 main reasons, and they tie directly back to how those scores are calculated. First, remember that length of credit history factor we'll get into more detail on.
Yeah, how long you've had credit.
Well, closing your older accounts can actually shorten your average age of credit history. Lenders like to see a long track record. A shorter history can look a bit less stable.
Okay, so keeping older accounts open helps show stability over time.
Exactly. And the second reason, and this one's maybe even more immediate, closing a card instantly reduces your total available credit.
Ah, the denominator in that credit utilization ratio calculation.
You got it. Let's say you have 3 cards. Total credit limits add up to $20,000. And maybe you have $5,000 in balances across them. That's 25% utilization.
Yeah.
5K, 20K.
Okay.
Now, you decide to close an old card you never use and it had a $5,000 limit. Your total available credit just dropped to $15,000.
Yeah.
But you still have that same $5,000 balance. Suddenly, your utilization jumps to 33%, 5K, 15K, just from closing the card, even though you didn't spend a penny more.
Wow. And higher utilization generally means a lower score.
Bingo. So the advice is usually if an old card doesn't have an annual fee, it's often better to just keep it open.
Even if you don't use it much.
Yeah. Maybe stick it in a sock drawer and set a reminder to buy a coffee with it every 6 months or so and pay it really right off, just to show some activity so the issuer doesn't close it for inactivity. It's counterintuitive, but that's how the math works.
That really highlights how the score reflects the algorithm's rules, not necessarily just common sense financial moves. Okay, one last big myth for this section. Myth number 5. Your income and how much money you have saved determine your credit score.
Right, this feels like it should be true, doesn't it? More money equals less risk. Seems logical.
Yeah, totally.
But it's completely false. Your credit score is designed to measure one primary thing: how you manage debt. It is not, I repeat, not a measure of your wealth, your income, or your savings account balance.
So the credit bureaus, they don't actually know my salary. They can't see my checking account.
Nope. They have no idea what you earn, what your bank balance looks like, or how much you've got stashed in your 401k. That information simply isn't part of your standard credit report or score calculation.
Huh. So theoretically, you could be a millionaire, but if you're consistently late on your credit card payments, you could have a really bad credit score.
Absolutely. And conversely, someone with a pretty modest income, but who has a long history of meticulously paying every bill on time and keeping their credit card balances super low, they could have an excellent score. It really boils down to your habits with borrowing and repaying.
Not your net worth.
Fascinating. Okay, so we've shot down some major myths, cleared up a lot of confusion. We know what doesn't determine your score or common mistakes to avoid. Now let's flip it. Let's get constructive. How is your score actually calculated? What's the real recipe?
Exactly. Now we get to the good stuff. While, the precise mathematical formula is proprietary, FICO, the company whose scores are used in the vast majority of lending decisions, they're actually pretty open about the 5 main ingredients that go into their scores. And they even give us approximate weightings for each category.
Okay, the secret ingredients revealed.
Pretty much. Understanding these 5 pillars is absolutely the key to taking control and actively managing your score. All right, you ready to break down the recipe?
Let's do it. What's the biggest, most important ingredient?
Okay, the single most crucial factor, the undisputed heavyweight champion, is your payment history. This typically accounts for about 35% of your FICO score.
35%. Wow, that's huge. It is. It's the foundation everything else is built on. And the core question here is really simple. Do you pay your bills on time?
Seems basic, but clearly has a massive impact.
Oh, absolutely. Just one payment reported as 30 days late can cause a significant drop in an otherwise excellent score. And obviously, more severe negative marks like accounts going to collections, repossessions, foreclosures, bankruptcies, those have very serious and long-lasting negative impacts. They can stay on your report for 7 to 10 years in some cases.
So practical takeaway number 1, loud and clear. Pay every single bill on time, every single time. Even if it's just the minimum payment required, getting it in before the due date is critical. That's the bedrock.
Okay, 35% payment history. What's next?
Coming in at a very important second place, accounting for roughly 30% of your FICO score, is amounts owed.
Amounts owed. So just the total dollar amount of debt I have.
Not exactly. It's a bit more nuanced than just the total debt load. While having way too much debt isn't ideal, this category primarily focuses on your credit utilization ratio. Ah, right, that percentage of available credit you're actually using. We touched on that when talking about closing old cards.
Exactly. That's the key metric here. So if you have a credit card with a $10,000 limit and you currently have a $3,000 balance on it, your utilization for that specific card is 30%. The scoring models look at the utilization on each individual revolving account, like credit cards, and your overall utilization across all of them combined.
Okay, so what's a good target to aim for with utilization?
The general rule of thumb you hear most often is to keep your overall utilization below 30%. That's kind of the standard advice.
Yeah.
However, for the very best scores, lower is definitely better. People with top-tier credit scores often keep their utilization consistently below 10%.
Below 10%? Wow, that's pretty low.
It is. It shows lenders you're not heavily reliant on credit. Now, it's not always practical day to day, but knowing that target helps. High utilization, say over 30% or especially over 50%, signals to lenders that you might be overextended, making you seem like a higher risk.
Got it. So, pay on time, 35%, keep balances low relative to credit limits, 30%. That's 65% of the score right there, the two biggest chunks. What makes up the other 35%?
Okay, the third factor is length of credit history, and this accounts for about 15% of your score. This ties right back to why closing those old accounts can hurt you.
Right, the average age of your account.
Exactly. This factor considers several things: how long your oldest credit account has been open, how long your newest account has been open, and crucially, the average age of all your accounts combined. Generally speaking, the longer your credit history, assuming it's a positive one with on-time payments, the better it is for your score. It demonstrates stability and experience managing credit over time.
So, time is your friend here. There's no real shortcut to building a long history.
Nope, afraid not. Just consistent, responsible use over the years.
Okay, 15% for history length. That brings us up to 80%. What are the last two pieces, each making up 10%?
All right, the fourth factor, accounting for about 10%, is credit mix.
Credit mix, what does that mean?
This refers to having experience managing different types of credit accounts over time. The main categories are revolving credit-thing credit cards, where you can borrow and repay repeatedly up to a limit, and installment loans. Installment loans are things like mortgages, auto loans, student loans, or personal loans, where you borrow a fixed amount and pay it back in predictable, regular installments over a set term.
So having a mix, like maybe some credit cards and a car loan or a mortgage, is seen as a positive thing.
It can provide a small boost, yeah. It shows lenders you can successfully handle different kinds of financial obligations, but, and this is a really important but, you should never go out and take on debt you don't need, like taking out a small loan just for the sake of improving your credit mix.
Right, the potential score benefit is small, and taking on unnecessary debt is risky and costs money.
Exactly. This mix often just develops naturally over time as your financial life progresses. Pay off an installment loan, like your car loan. Your score might dip slightly temporarily because you've lost that mix element, but that's no reason to keep paying interest. You don't have to.
Good clarification. So that ties back to the perfect score trap idea. Paying everything off might cause a small temporary dip. Okay, credit mix is 10%. We're at 90%. What's the final 10%?
The last 10% comes from new credit. This factor basically looks at how recently and how frequently you've been applying for and opening new credit accounts.
Okay, so this is where those hard inquiries we talked about earlier come into play.
Exactly. Applying for a lot of new credit in a short amount of time can be seen as a red flag. Lenders might interpret it as you being in financial trouble and desperately seeking funds, or maybe that you're about to take on a lot of new debt very quickly. Either way, it makes you look riskier.
So going on an application spree for 5 different store cards at the mall in one afternoon, probably not a great idea for your score.
Generally, no. That's likely to lower your score more significantly than just applying for one needed account. The key here is to be strategic. Only apply for credit when you actually need it, and try to space out your applications if possible. Don't just apply speculatively.
Okay, there it is. The whole pie. Payment history, 35%. Amounts owed utilization, 30%. Length of history, 15%. Credit mix, 10%. And new credit, 10%. That's the FICO recipe, more or less.
That's the framework.
Here's where it gets really interesting. Listening to all this, you see how the pieces fit together. It's not just random, it's a specific system, almost like a game with very particular rules. And once you know the rules,
You can navigate it much more effectively. That's the goal. Understanding how it works, those 5 factors, is critical. But remembering why this all matters is what keeps you motivated. The real-world impact of this number is just huge. We touched on it earlier, but it's worth hammering home. A good credit score acts like a master key. It unlocks better interest rates, better borrowing terms, and that translates directly into saving serious money.
let's revisit that mortgage example. How much difference can it really make?
Okay, back to that $300,000 mortgage. Over the full 30 years of the loan, the difference in total interest paid between someone with an excellent score, say 760 or higher, and someone with just a fair score, maybe down in the low 600s, It could easily be $50,000, $60,000, maybe even more, depending on the interest rates at the time.
$50,000 or $60,000, that's life-changing money. That's retirement funds, college tuition, starting a business.
Exactly. It's real money that stays in your pocket, giving you financial freedom, just because you manage your score well. And it's not just those massive loans either, right? It trickles down.
Yeah, how does it affect things like renting?
Oh, big time. Landlords rely heavily on credit checks. A low score might mean you get rejected outright for the apartment you want. Or maybe they approve you, but they demand a much larger security deposit, sometimes first and last month's rent, plus an additional deposit. That could be a huge upfront financial barrier for people.
A massive hurdle, yeah.
And you see it with other things too. Setting up utilities sometimes, or getting a new cell phone plan without a hefty deposit. If your credit's poor, companies might require hundreds of dollars up front just to give you service. It adds these extra costs and obstacles to just basic necessities. It really does permeate almost everything.
Okay, so the stakes are clearly high, but we should also probably touch on this. The system itself, is it perfect? Does it treat everyone fairly? Are there, built-in flaws?
That's a really important question. And the honest answer is no, the system isn't perfect. It definitely has flaws and can perpetuate existing inequalities.
How so?
Well, for one, it's based almost entirely on your history with traditional forms of credit loans and credit cards from established institutions. If you don't have easy access to those, maybe because of where you live or your income level, or if you primarily use cash, it can be really hard to build a credit history and score, even if you're very financially responsible in other ways. You end up with a thin file, which makes it hard for lenders to assess you.
Right, it doesn't capture your whole financial picture.
Not at all. As we discussed, it completely ignores your income, your savings, how much cash you have, your budgeting skills, your assets. It's laser focused on how you've managed specific types of debt within their defined system.
This raises an important question then.
It does.
Knowing the system has these flaws, that it isn't a perfect measure, why should people bother learning to play this game? Why engage with a flawed system?
That's the pragmatic reality check, isn't it? You bother because, like it or not, this is the system lenders currently use to make incredibly important decisions that deeply affect your financial life and opportunities.
So it's about working within the current reality.
Exactly. Learning the rules isn't about saying the system is great or fair. It's not about obsessively chasing a perfect 850 score just for bragging rights, falling into that potential trap we mentioned. It's about understanding how lenders evaluate risk right now so you can present yourself in the best possible light within their framework. It's about accessing the tools like affordable loans for a home or car that can help you build a better future. It's about empowerment through understanding the current game board.
So what does this all mean for you listening? Hopefully this deep dive has equipped you. You basically hold the study guide now. No more feeling like you're taking some mystery test blindfolded, the curtain's been pulled back. You know now that your score isn't some reflection of your moral worth.
Definitely not.
It's not even the full story of your financial health. It's just a snapshot of how you've handled debt in the past, filtered through this specific, sometimes kind of quirky algorithm. You're not just passively getting a grade anymore. You're an active player who knows the rules.
You're in the driver's seat.
You know the absolute bedrock is paying bills on time, every time. Job one.
Non-negotiable.
Keeping those credit card balances low compared to the limits, managing that utilization, aiming under 30%, ideally under 10%, is crucial.
Hugely important.
You get why protecting your credit history matters, why keeping old fee-free cards open often helps, lengthening history and helping utilization.
The double win.
And to be strategic about new credit applications, not just applying randomly. You understand the why behind score changes, even the weird temporary dips.
That understanding is everything. This knowledge, this deeper insight, it really is your key to turning the tables, to potentially saving yourself a fortune over your lifetime and unlocking those financial doors, the good mortgage rate, the apartment, the lower insurance premium that you deserve. You really can take control.
That's the goal. Control through knowledge. So if this deep dive sparked some aha moments for you, if you felt these insights were genuinely unique, cutting through the usual noise.
Yeah, the kind of practical, tested wisdom we really value finding in the sources we draw from.
Then there's always more to learn and apply. We love bringing you these deep dives, synthesizing valuable information to empower you.
Absolutely.
So hey, don't miss out on more content like this that really aims to give you that practical edge. Go ahead and hit that subscribe button. And check the description below. We'll always put links there to related deep dives, useful tools, and other great resources.
Definitely keep learning, keep applying, and maybe one last thought to leave you with. Remember, your credit score isn't a judgment on your value as a person. It's just a number spit out by an algorithm. The real power isn't in obsessing over hitting a 50. It's in understanding why that number matters in today's system, and then making that system work for your goals, for your financial freedom. Use the score, don't let the score use you.